Analysts at UK-based Exotics Partners have said that the net interest income for banks such as Equity, CFC, Stanbic, Cooperative, Diamond Trust Bank, KCB and NIC Bank could decline by an average of 22.5% to 5.8% of total revenues next year due to reduced lending rates and a potential decline in yields on treasury bills and bonds.
When you harmonize and commoditize the lending, then it's only those of a certain risk who would get the money. The current structure is worrying a little bit because it doesn't recognize risk. Irrespective of your risk, you pay 4%. So what will happen is that banks would say, who is on a 4% risk? And that will be the person who get those below would then somehow be denied. We are concerned.
The returns on the 91-day Treasury bill has fallen from 22.13% in October 2015 to as low as 8.03% by last week. The new law caps lending rates at 4 percentage points above the central bank rate, which currently stands at 10%, and the minimum deposit rate that banks give customers to 70% of the benchmark rate. According to the report, the aggressive bidding for government securities should lead to decline in their yields and thus enable banks to reprice their term deposit costs downwards. According to the analysts, there is a strong historical correlation between banks' deposit rates and the 91-day Treasury bill rate, implying that the banks' deposit rates could reduce due to the decline in the average 91-day Treasury bill rate from 21.65% in October 2015 to 9.79% in July this year. Equity Bank, which has operations in Uganda, Kenya, Tanzania, Rwanda, Democratic Republic of Congo and South Sudan, posted an 18% growth in net profit to 15.1 billion Kenya shillings during the 9 months to September 30th, but the net interest margin grew marginally from 10.2% to 11.5%.
Bankers have no objection to regulating. It's the mechanism. As I said, it's the tool. We're using the wrong tool. We are doing it in a way that everybody knows can't work. That's the reality. It's not the interest rates that shouldn't go down. It's how you do it. How do you do it?
The Kenyan market has reacted aggressively by moving money from the banking industry to treasury bills after the capping of interest rates. Equity Bank, Uganda subsidiary, contributed 2.3% of the group's profit, DRC 2.4%. Tanzania 1.4% and Rwanda 1.3%. However, South Sudan subsidiary is going through a crisis following the depreciation of the South Sudan pound, leading to the erosion of the bank's balance sheet from 500